There's this guy I know. Let's call him Marcus. 42 years old, makes $90,000 a year, solid job, has a 401k, does everything the financial advisors tell him to do. And one day he's sitting in his cubicle doing the math and realizes at his current pace, he'll be 71 before he can actually quit. Not 65, 71, because inflation exists and his contributions stayed flat for a decade. He looked at me and said, I'm buying back half my life at twice the price. That's when I realized most people aren't failing at retirement because they're bad with money. They're failing because nobody explained what the game actually is. Here's what I'm going to show you. How to stop working in 10 years using a system that requires exactly 0 market timing, 0 stock picking genius, and 0 crypto gambling. I'm going to break down the psychological traps that keep people stuck, the 3-layer wealth structure that actually works, and why the 25 times rule isn't some magic formula, but basic math that nobody bothers to explain properly. Look, the reason most retirement advice sounds like a motivational poster is because the people giving it have never actually done it. I've been running my own business for over 10 years. I'm surrounded by accountants and fiscal lawyers who taught me how money actually moves. I have multiple hundreds of thousands of dollars invested. This isn't theory. This is what happens when you read the boring documents and figure out what actually matters. Think of your wealth like buying back your own time in chunks. Every month you work, you're selling roughly 160 hours of your life. Your job is to flip that trade, to build a pile of assets so big that it buys back those hours for you forever. That's it. That's the whole game. But here's the thing, nobody tells you. You're not buying back your life with one big purchase at the end. You're buying it back in pieces, 1% at a time. I learned this from a business partner who retired at 48. He told me a story about his daughter's soccer games. For years, he missed them. Every Saturday, had to work. Then one year, his investments were throwing off enough cash that Saturdays were covered. He didn't quit his job. He just bought back Saturdays. That's 6,240 hours of his life he got back before he ever fully retired. And that shift, that tiny slice of freedom, changed how he saw everything. He wasn't grinding towards some distant finish line anymore. He was collecting pieces of his life back, one at a time. This is the framework that makes early retirement possible. You measure progress in freedom units, not account balance. Freedom units. If your life costs $5,000 a month and your portfolio generates $500 a month in passive income, you're 10% free. That's not abstract. That's half a workday every single week that you've permanently bought back. And once you see it that way, the math gets really interesting really fast. Now, you might be thinking, sure, that sounds nice, but how do I actually build that pile of assets in 10 years instead of 30? Here's where most financial advice completely falls apart. They tell you to save more and spend less, which is technically true, but practically useless. It's like telling someone to lose weight by eating less and moving more. Correct. Unhelpful. The real answer has 3 parts. And if you miss any one of them, the timeline doubles. Part 1 is the income side. You cannot budget your way to wealth. I'll say it again. You cannot cut enough lattes to retire early. I've seen the numbers. If you're making $50,000 a year and saving 20%, that's $10,000 a year. Respectable, disciplined, slow. It'll take you decades. But if you make $150,000 a year and save the same 20%, you're putting away $30,000 a year. Same discipline, triple the speed. The difference isn't your character, it's your earning power. Here's a story that explains this better than any spreadsheet. I know 2 guys, same age, both started investing in 2008. Let's call them Josh and Ryan. Josh is a teacher, makes about $65,000, saves 15% like clockwork, never misses a month. Ryan's in software sales. Started at $70,000, but pushed himself to learn high-value skills. Sales psychology, negotiation. By 2015, he's at $120,000. By 2020, $180,000. Here's the thing. Ryan's lifestyle only went up a little. He bought a nicer car, moved to a better apartment, but he didn't let lifestyle creep eat the whole raise. He kept saving that same 15 to 20%. Today, Josh has about $230,000 saved. Solid, impressive discipline. Ryan has over $700,000, same time frame, same basic habits. The difference is income velocity. And this is where people get mad at me, because I'm supposed to tell you that all you need is discipline and patience. But that's a lie sold to you by people who want you to stay poor and feel good about it. Discipline matters, but income is the multiplier. Part 2 is the structure. You need 3 layers in your wealth stack. I call it the house model because every strong house has a foundation, walls, and a roof. The foundation is growth assets, index funds, stocks, boring stuff that compounds at 7 to 10% a year on average. This is the engine. Without it, your money just sits there getting eaten by inflation. The walls are income producers, dividends, real estate, anything that puts cash in your pocket without you selling shares. This gives you flexibility. You can cover expenses without liquidating your growth assets during a downturn, which is when most people panic and destroy their plans. The roof is stability, bonds, cash reserves, maybe some gold if you're paranoid, which, to be fair, isn't the worst instinct when central banks are printing money like it's Monopoly night. Here's why this structure works. Let's say it's 2009. The market just crashed. Your portfolio is down 40%. If everything you own is stocks, you're in psychological hell. You're watching your account bleed, and every instinct is screaming at you to sell. But if you have that second layer, those income producers, you've got cash flow covering your expenses. You don't have to sell anything. You can sit there, dead calm, while everyone else panic sells at the bottom. And that's the whole game. Staying in when everyone else is running. I saw this play out with a guy I know who owned rental properties during 2008. His stock portfolio got hammered, but his tenants kept paying rent. He didn't sell a single share. By 2012, his net worth had more than recovered while most of his friends were still trying to crawl back to even. The lesson isn't go buy rental properties. The lesson is build a structure that keeps you psychologically stable during chaos, because your brain is your biggest enemy in this game. Part 3 is the feedback loop. You need to increase your contributions every year, not by a lot, 3 to 5%. Here's why. If you're putting in $1,000 a month this year and you just keep doing that forever, inflation will eat your gains. But if you bump it to $1,030 next year, then $1,061 the year after, you're quietly outrunning inflation without even feeling it. Over 20 years, that tiny increment turns $760,000 into over $1 million. Same portfolio, same returns. Just a 3% annual increase in contributions. And here's the kicker. Nobody tells you this. The financial services industry doesn't want you to know this. Because if you did, you'd realize you don't need their high-fee actively managed funds. You'd realize the whole game is just basic math and behavioral psychology. You'd realize you can do this yourself. And then they lose their 2% annual fee on your $1 million portfolio, which is $20,000 a year, every year, forever. That's why they make retirement seem complicated. Complexity is the product. Confusion is the business model. Let me give you a case study with actual numbers so this feels concrete. Let's say you're 35 years old. You're making $80,000 a year right now. You're saving 20%, so that's $16,000 a year going into investments. You're investing in a simple index fund averaging 8% annually, which is conservative based on historical data. At that pace, in 10 years, you'll have about $245,000. Not bad, but nowhere near retirement. Now, let's add the income multiplier. Let's say you spend the next 3 years building a high-value skill. Could be anything. Sales, coding, consulting, copywriting, content creation. Doesn't matter. What matters is you push your income from $80,000 to $130,000 by age 38. You keep your lifestyle mostly flat. Maybe you spend an extra $10,000 a year. That's fine. you're now saving $30,000 a year instead of $16,000. And here's where it gets wild. By age 45, you'll have about $720,000. You didn't change your investing strategy. You didn't time the market. You didn't buy some meme coin. You just increased your earning power and stayed consistent. But wait, because this is where the 25 times rule comes in and blows the whole thing open. If your lifestyle costs $60,000 a year, your magic retirement number is $1.5 million. Why? Because at a 4% withdrawal rate, 1.5 million throws off 60,000 a year forever. That's the math. It's not complicated. It's just that nobody explains it without wrapping it in jargon and selling you a course. So you're sitting there at age 45 with $720,000. You're not done yet, but you're halfway there. And here's the psychological shift that changes everything. You're no longer measuring your progress by your account balance. You're measuring it in freedom units. At $60,000 a year in expenses, that's $5,000 a month. If your portfolio is generating $2,400 a month, you're 48% free. That's almost half your life bought back. You could quit your job and work part-time. You could take a sabbatical. You can negotiate a 4-day work week because you don't need the money as badly as your boss thinks you do. This is what financial independence actually looks like before you hit the finish line. It's leverage. It's options. It's saying no to things you hate because you've built a cushion that lets you breathe. And that feeling, that shift in how you move through the world is worth more than any account balance. Now, here's the part where I lose some of you, but I'm gonna say it anyway because it's true. The biggest obstacle to early retirement isn't market returns. It's not inflation. It's not taxes. It's your own psychology. Specifically, your inability to delay gratification and your addiction to looking rich instead of being free. There's a concept I learned from a fiscal lawyer I work with. He calls it the performance tax. Every time you buy something to signal status, a nice car, a fancy watch, a bigger house than you need, you're paying a performance tax. You're trading future freedom for present perception. And the math is brutal. If you spend $40,000 on a car you don't really need, that's not just $40,000. That's $40,000 that could have compounded at 8% for 20 years. That's $186,000 of freedom you just traded for a depreciating asset that'll be worth $12,000 in 5 years. I'm not saying live like a monk. I'm saying every dollar is a soldier. You can either send it to work building your freedom, or you can send it to the mall to buy you a temporary dopamine hit. One path looks rich today, the other makes you free tomorrow. And here's the thing. Most people can't tell the difference until it's too late. Let me tell you about a guy I met at a conference. Let's call him Derek. He's 53, makes $250,000 a year, lives in a $4 million house, drives a $110,000 car, sends his kids to private school. And he told me, dead serious, that he's trapped. He can't retire until he's at least 65 because his expenses are $18,000 a month. He built a life that looks successful from the outside, but requires him to keep working into his 70s. That's not wealth. That's a prison with a nice view. Compare that to another guy I know. Call him Alan. Makes $140,000, lives in a house worth $600,000, drives a Honda. His expenses are about $5,000 a month. At 50, he had $1.8 million saved. He could have retired right then. Instead, he kept working part-time, doing consulting because he liked the work, not because he needed the money. That's freedom. That's what we're actually trying to build here. So here's the reversal nobody talks about. You think the problem is that you don't make enough money. But for most people, the real problem is they've built a life that costs too much. And the psychological trap is that every time you increase your income, your lifestyle expands to match it. It's called the hedonic treadmill. You make more, you spend more, you feel the same, and you never get ahead. The only way to break that loop is to consciously uncouple your income from your expenses. Grow one, stabilize the other. That's the gap where wealth lives. Now, let's talk about the 25 times rule in detail, because this is where it all comes together. If you want to retire, you need to know your number. And your number is just your annual expenses multiplied by 25. That's it. If you spend $40,000 a year, your number is 1 million. If you spend $60,000, it's 1.5 million. If you spend $100,000, it's 2.5 million. The reason this works is because of the 4% rule, which says you can safely withdraw 4% of your portfolio every year without running out of money. It's based on historical market returns and withdrawal rates studied over decades. It's not perfect, but it's the best framework we have. Here's where it gets tactical. If you're aiming for early retirement, you might want to be more conservative. Use 3.5% or even 3%. That bumps your 25 times number to about 28 or 33 times. So if you spend $60,000 a year and you want extra safety, your number becomes closer to 2 million instead of 1.5 million. Is that harder? Yes. Is it more secure? Also yes. You're buying insurance against sequence of returns risk, which is just a fancy way of saying a market crash right when you retire could screw up your whole plan. But here's the thing most people miss. You don't have to save that whole number out of pocket. Compounding does most of the work. Let's say your target is 1.5 million. If you're starting with 50,000 already saved and you're putting in $2,000 a month at 8% returns, you'll hit 1.5 million in about 23 years. But if you increase that contribution by just 5% every year, you'll hit it in 18 years. And if you can push your monthly contribution from $2,000 to $3,000 by increasing your income, you'll hit it in 14 years. Same market returns. Totally different timeline. That's the income multiplier at work. Here's another angle. Let's say you're 40 years old right now. You want to retire by 50. You have 100,000 saved. You're putting in 3,000 a month. At 8%, you'll have about 670,000 in 10 years. Not enough if your number is 1.5 million. But if you increase your contributions by 7% a year and you push your income up so you can contribute 4,000 a month by year 3, you'll cross 1 million by year 10. Still short, but you're 70% of the way there. And here's the secret. You don't have to fully retire at your target date. You can go part-time, you can do consulting, you can work on passion projects. Because the closer you get to your number, the less the outcome matters. You've already bought back most of your life. Lazy investing built more fortune than crypto memes. I've watched this play out over and over. The people who got rich fast almost always lose it fast. The people who built wealth slowly and boring are the ones still standing. And the reason is psychological. Fast money doesn't teach you the skills you need to keep it. Slow money forces you to learn discipline, patience, and systems thinking. It forces you to understand how incentives work. It forces you to confront your own weaknesses. That process is the real wealth. The money is just the receipt. So let's bring this back to the beginning. Remember Marcus, the guy who realized he was buying back his life at twice the price? Here's what he did. He didn't quit his job. He didn't panic. He sat down and mapped out his 3-layer structure. He calculated his freedom units. He realized he was already 12% free and didn't even know it. That shifted everything. He stopped seeing retirement as this distant binary thing where you either work or you don't. He started seeing it as a spectrum. And once he reframed it that way, the pressure lifted. He increased his income by switching companies and negotiating a better salary. He bumped his contributions by 5% a year. And now, 3 years later, he's at 31% free. He bought back every Friday, works 4 days a week. His quality of life exploded. And he's on track to fully retire at 56 instead of 71. 15 years bought back. Not because he got lucky, because he understood the game. Here are your 3 takeaways. 1. Stop measuring progress by account balance. Measure it in freedom units. How much of your life have you bought back? That's the number that matters. 2. You can't budget your way to wealth. You need to grow your income while holding lifestyle creep in check. That's the gap where compounding actually has room to work. 3. Build a 3-layer portfolio. Growth for compounding, income for cash flow, stability for psychology. That structure keeps you in the game when everyone else is panic selling. The financial services industry wants you to think this is complicated so they can charge you fees to manage your confusion. But it's not complicated. It's just math and psychology. And if you understand both, you can buy back your life in 10 years instead of 40. The only question is whether you'll actually do it. Because knowing the plan and executing the plan are two very different things. And most people will read this, nod along, and change nothing. Don't be most people.